Now we have Mr. Robertsen online, Global Head of Research and Chief Strategist from Standard Chartered Bank. Hello, Mr. Robertsen. Thank you very much for your interview today.
Good afternoon.
Good afternoon. So the first question I want to ask is basically how you see the global financial markets in 2020 next year. So how do you see FX and equity and credit markets for the remaining period of 2020 and next year?
Sure. I think the most important thing to say is that we continue to see a significant difference between financial market performance and economic performance. The global economy, as well as many regional and specific country economies, continue to see quite a few challenges. Exports remain weak. Consumer spending remains weak because of concerns about the health crisis. And the global economy, in our opinion, will remain in a recession for 2020. We do expect a recovery in 2021, partially due to we do expect an improvement in 2021, partially due to base effects, but also because of the significant monetary and fiscal stimulus that we are seeing. And this stimulus that we are seeing is in many ways the reasons why financial markets have performed so well since the lows in March and April. We've seen quantitative easing from developed market central banks, but also emerging market central banks around the world have been purchasing assets for the first time. We're also seeing a significant increase in fiscal stimulus. So we do expect a recovery, but the economic recovery will be slow, and there do remain quite a few challenges.
You briefly mentioned monetary easing and fiscal easing due to the coronavirus. Do you think there will be drawbacks or some setbacks to this kind of massive liquidity situation currently? Because as you know, the stock market is rising, but you've also mentioned the discrepancy between the real economy and the financial markets. So do you think there will be some problem related to this in the near future?
I don't know if I would say problems, but I do see risks. And I see two kinds of risk. Specifically for the stock markets, quantitative easing is lifting the prices of many companies and stock indices. But at some point, corporate earnings have to catch up. And our concern is that a number of companies still have a very difficult earnings environment. And so at some point, the gap between prices and earnings has to resolve itself. The other risk that we see is on the fiscal stimulus side. For most countries, for most governments, fiscal stimulus is also requiring a significant increase in debt issuance. And debt to GDP ratios are going up around the world. Korea, China, the United States, etc. Nobody is exempt from this. And the problem is, in a world where there is such a significant increase in the amount of debt, the interest expense associated with servicing those debts is a big drain, not only on government finances, but on corporate finances. So I see that as a risk for the next year or two.
Okay, thank you for your response. You mentioned the global economy has went through so much volatility and extreme panic during March after the coronavirus. Because of the risk you talked about, government debt and the discrepancy between the real economy and the financial market, do you think some kind of panic that occurred during March can be happened again? Maybe.
Yeah, look, while we have some concerns, I don't think I would say we expect another episode of such extreme volatility. Part of the reason for that volatility was because of the surprise, the real shock in the health crisis, which, as we all know now, spread much faster than anyone expected. And typically, when you get these kinds of volatility or VAR shocks, as we call them, a big driver of that is the surprise. Today, we know the difficulties related to the health crisis. We know the difficulties related to the economic recovery. And so while there may be periods where we have setbacks or renewed periods of weakness, policymakers are really very much aware of the challenges that are out there. And again, they will put an enormous amount of stimulus in place to support both the economy, markets, and the banking system. So we could see more volatility in the future, but not like we saw in March and April.
I think that's good news. So we also have U.S. elections coming up just in a month. And as you know, like President Donald Trump got tested positive for the coronavirus. And this whole uncertainty revolving around the election is just growing. So how do you assess U.S. elections risk factor in global financial markets? What effect it might have on the markets? What's your opinion about this?
We've written about 3 different scenarios. In some ways, I think the easiest scenario to understand or describe is if Joe Biden, the Democratic candidate, wins in a clean election where the result is obvious. In that scenario, his domestic and his international agenda to us mean that the dollar would sell off and global assets, equities, credit, commodities would perform well, but U.S. assets may struggle because he plans to increase taxes on U.S. companies and on individuals. So we would see a shift in the U.S. Tax regime and a shift in a positive direction towards global trade. If Donald Trump is elected, we have a bit more of an uncertain environment to look for. He will increase government spending, which is good news. He will keep tax rates in the U.S. very low, also good news. But from an economic point of view, that will put further pressure on the U.S. government's sovereign balance sheet. We also know that his approach to global trade and geopolitics is a bit more unpredictable. So I think risk premium on global markets would remain relatively high. There's also a third scenario, which is that the election result is challenged or contested in the days and weeks after the election. If the election is very close, we would imagine that mail-in ballots would receive quite a bit of scrutiny, and it could be weeks or even several months before a winner is announced. Now, that's not our base case scenario. It is what we call a tail risk or a black swan event. And the good news is most market participants now seem to be aware of this risk. But obviously, anybody watching this election would like to see a clean and quickly resolved result in the days after.
Okay, so currently, you think the biggest risk factor in global financial market for the remaining period of 2020 is possibly the U.S. election?
I think that's right. Look, in the short term, which I would describe as the next 2 or 3 months, the U.S. election is what we would call the biggest risk factor for markets. Assuming we have a quickly resolved election in November, the markets will very quickly start to look to 2021 and the economic outlook and the policy outlook.
We also have the coronavirus spreading, and it's winter's coming, and some people worry about there will be second pandemic where the virus will be spread in a very massive scale. So in this case, you mentioned earlier that next year the economy will pick up in a very slow pace. But is there any possibility that the coronavirus aggravation can somewhat drop the economy in a way that it did in 2020, earlier in 2020?
It's a very good question. I would describe the outlook as follows. Until we have a vaccine, the risk of a second or even a third wave of COVID infections, I think, remains relatively high. The good news from a medical point of view is that the second and third waves that we are seeing, while the infection rates and the contamination rates or contagion rates are very high, hospitalization rates and mortality rates seem to be going down. So society seems to be able to sort of move forward with the risk of COVID. That's not to say that the economic risks are behind us. As we have seen in a couple of countries recently, we are seeing new restrictions put in place that will put pressure on the domestic economy. But the good news is we do not believe that any country will go back into an imposed full lockdown, which is what caused so much economic damage in March and April and May. So we could see renewed weakness in 2021. Our base case is economic growth, but with a slow trajectory. And then as we get into 2022 and the base effects fall out of the data analysis, then we would expect a renewed period of a soft economic outlook.
Okay. In case of Korea, Korea didn't really impose any lockdowns, economic lockdowns, but efficiently managed to curb the virus in a way. And a lot of people are evaluating Korea's coronavirus response relatively good than its peer countries. What is your evaluation of Korea's coronavirus current status?
Look, I guess the challenging news is that we still expect economic growth in Korea to be just ever so slightly negative. So a what I would call a mild recession by comparison to many other countries. And so relatively speaking, Korea's economic outlook looks a little bit better. We have seen a significant improvement in exports. So the decline in exports from Korea year on year are still negative, but much less so than they were in March and April. So the negative momentum has eased up or slowed down, depending on how you like to describe it. So I would say that the external factors for Korea have been more negative than the domestic factors. That being said, there are still some challenges from a capital flow point of view. We still believe that Korea will experience one of the worst years of a balance of payments conditions since the financial crisis. A lot of that is due to the capital account. And what that means in summary is that we are seeing fewer inflows into the Korean markets by foreigners. And we're also seeing a number of Korean investors move more of their capital to overseas markets in search of higher returns. Korean bond yields are extremely low, and we have seen a significant asset allocation shift out of Korea's markets and into foreign markets. So the flow story is, in our opinion, still a bit of a concern. That being said, as you correctly point out, the economic outlook, the COVID outlook looks relatively positive. China's economy is improving, which is offering a bit of support to the whole region, not just Korea. And from an FX point of view, the weakness in the dollar that we have started to see is actually offering quite a bit of support to the Korean won. And that currency stability should start to attract foreign capital again.
As you mentioned, like every country's government and central banks worldwide, they're working against this coronavirus and just putting in stimulus. And there are problems you mentioned, such as the debt levels. And I think there can be some gap in the government's capability to give in some capital. And this could result in differentiated performance of markets. So do you think this kind of gap can happen?
I would say it's certainly a risk. And look, you correctly point out that we are seeing an increase in government spending. For example, the budget deficit in Korea is deteriorating, but it's deteriorating for all countries. If you look at the debt to GDP ratio, when we started the year, the debt to GDP ratio for Korea was below 40%. It will be nearly 50%, perhaps by the end of this year and into next year. And over the course of the next 3 to 4 years, the debt to GDP ratio in Korea could go up towards 50, 55, even 60%. That's the bad news. The good news is that interest rates in Korea still remain historically pretty low. So the cost of servicing that larger amount of debt is still quite reasonable by international standards. But what you are seeing, and I think you will continue to see, is a number of bond markets like Korea's. The yield curve may steepen where long-term interest rates are going up at a faster pace than short rates. The Bank of Korea is expected to keep policy rates relatively low, and that should continue to support the front end of the yield curve.
Okay, thank you very much for your response. I think I've dealt with almost all the questions I've prepared. Is there any other points you would like to add on our discussion?
I guess I would make one point on Asia more generally, which is that considering that the health crisis appears to have originated in Asia, and specifically in China, we actually have seen a pretty healthy recovery in a number of the economies in the region. And we do expect that to continue. And from an international investor point of view, I would also argue that the volatility in the markets in Asia has been much less over the last 3 or 4 months than it has been in other markets around the world. And that lower volatility or relative stability, in our opinion, is ultimately going to bring investor capital back into the region. So, we have a very constructive view on emerging markets and Asia in particular, and that's one of the reasons. So we view markets in this Asia-Pacific time zone to be, relatively attractive for a number of reasons.
Well, thank you very much for your opinion. Hope you enjoyed our interview today.